And welcome into Making Sense. We're just about at the midpoint of 2014. Wow, where does the time go? Time seems to fly, but you know what? You're probably sitting there saying, yeah, time is flying, but I wonder what's going on in the stock market. I'm wondering if I'm going to be able to survive 2014. Well, here today with the survival guide is Brandt McDonald with McDonald, Barranco, Hagen Wealth Management.
Right, that's right.
Glad to have you back again. And Brandt, we're at the middle part of 2014. Everything seems to go at warp speed here.
It really does. You know, we've spent an enormous amount of time and energy and research into what's happened in the first part of the year. And we've already sort of calibrated our plans for the back half of 2014, and we're really looking at 2015 now. And let me tell you, there's not a shortage of things to keep up with in the global marketplace, that's for sure. You know, currently we've got the Russian-Ukrainian situation that everyone is glued to. That has a dramatic impact on energy prices, particularly in Europe. And then, of course, you have the unrest in the Middle East with the Israeli-Hamas situation. And then also here, U.S. domestic. So when you look at the first half of the year, earnings in the first quarter hummed along pretty well, sort of almost like we're stuck in neutral.
And that was kind of blamed a little bit on the weather.
Well, let me tell you, the weather was an absolutely, I mean, it was a major part of the negative GDP numbers that we experienced. And by the way, we've seen, I think, 3 revisions now to first quarter GDP, and now it's a negative number of around a little over 2%. But the good news is the second quarter we've seen a sharp snapback, which you would expect to see, particularly with weather-related events.
Let me just, when we say the word GDP, gross domestic product.
That's right.
For our viewers that might say, okay, what does that mean? In simple terms, what would that mean? Well,
it's the total economic output of the United States of America.
Okay,
so think of it as the revenues of the whole country.
Right.
If you took all private businesses, public businesses, even government spending, and you lumped it all together, it gives you an idea as to how healthy the overall economic activity of the U.S. domestic economic situation.
And a lot of that is based on imports, exports.
Yes, it can be. It definitely can be. You get into some pretty complex economics discussions that I'm not sure we want to do today.
No, we don't.
But
just as we use acronyms, sometimes our viewers will say, "Well, you use that acronym." They'll tell me.
Right.
You know, tell us what it means in simple
It's really
terms.
not anything different than if you own a business and you're looking at your company's revenues.
Right.
You want to know, are those revenues flat, or are they growing, or are they contracting? That's sort of what GDP is. But we've seen a little bit of a recovery in the second quarter, and here we are sort of at the middle of the year. And as we speak, you know, we're getting second quarter earnings announcements. For the most part, top-line revenue growth has been flat to slightly rising. Earnings per share have been going up, and that's been a story that's been continuing now for the last couple of years. But the reason why is because U.S. corporations are borrowing money, you know, in this low interest rate environment, and they're using those proceeds to go out and buy their own stock. So they're retiring the number of shares outstanding, and when you, not to get too complex, but when you take the raw net income number of these companies and you're dividing fewer shares into it, it causes the earnings per share to go up. So you have to be mindful of that, particularly when you're looking at various valuation metrics in the market, things like price to earnings multiple, price to cash flow, some of those type things. You really want to be careful, particularly on the share count. But
and a lot of it's the fact that they've just cut back employees too.
They have. You know, U.S. corporations, you know, the one silver lining in all of this is that U.S. corporations are probably in the most healthy shape they've been in over 50 years. I mean, if you look at the balance sheets of these companies, they're incredibly strong. They're loaded with cash. They've recalibrated their entire business process, streamlined it. It's much more operationally efficient. But part of the problem with that, because of some legislative changes with the Affordable Care Act, or sometimes called Obamacare, a lot of these companies, you know, reduce their payrolls or sort of change the character of their payrolls from pure full-time employees down to 30 hours a week or less. That's had a huge impact on the labor force. And when you look at the unemployment numbers in particular, that's what we see in the U6 number, or what we call the labor participation rate, is the lowest it's been since 1978. And you know, the labor participation rate has always been there, and it's always kind of hovered around that 10 to 12% mark. But in this situation, it's been a little bit more problematic than in prior jobs recoveries. And I think the biggest impetus to or the greatest roadblock, if you will, to a jobs recovery has been fiscal issues in Washington, congressional gridlock, and so on and so forth. I know on another show we'll talk about the midterm elections that are coming up and the impact that that will have on our money and on global financial markets.
Good. Well, thank you so much for that. We're going to get you to come back. We need to talk to people about thinking about retiring. Well, maybe he's the guy you need to be talking to more than just on this show.
Well, we would love that.
Absolutely.
Absolutely.
And we'll be right back right after this.